Warren Ingram, of course, certified financial planner at Galileo Capital. Warren, we talk about the value of our rands all the time. We're going to be talking about the value of the rand and how it moves our money today. And I mean, I spend my life talking about the value of the rand to the US dollar. Why is it such a big deal? I mean, why does it matter so much?
I mean, understanding that it affects almost every aspect of our lives where something has a price. Stephen, if you're buying food, you would think that the dollar has no impact, but a lot of our food items are dollar related. When they quote the price of maize, it's not quoted, unfortunately, in global terms in rands, it's quoted in dollars. And if you go through something like fuel, oil in particular, you'll notice that it's always, dollars per barrel. And the price of fuel, again, has an enormous impact on our economy. It affects the cost of transport, which means that it affects every single item that gets delivered to a shop. And then, we have to get to the shop and so on and so on. So the moment you look at the rand and you look at how it's moving against the dollar, if life is volatile, which it seems to me every single day of our lives at the moment, and especially the currency, it means that our cost of living is hugely impacted by the rand dollar. And cost of living, the only thing that the Reserve Bank can do to control the cost of living is use interest rates. So if we're dealing with rising cost of living because of imported inflation from the weak rand versus the strong dollar, then we're in a position where the Reserve Bank has to respond to that. And so they push up interest rates, which makes our mortgages more expensive, our credit cards. It makes it difficult for government to have enough money to buy and pay for infrastructure because it's got to service debt. And so you can see very quickly how you can get into a real downward spiral with a very strong dollar and a very weak rand. And equally, that if that cycle turns, how it can become something of a virtuous circle.
Okay, and then, I mean, what pushes the value of the rand up and what pushes it down? And you're not allowed to say because there are more buyers than sellers.
I always think, famously, we one of our not current cabinet ministers said, it doesn't matter, we'll just move the rand in our own direction or something like that. We'll just pick up the rand.
We'll pick the rand. We'll pick up the rand. Nomvula Mokonyane, it was you.
Nomvula Mokonyane, I wish we could do that. I wish there was someone in our government that was that powerful that could just pick up the rand. So I think to understand one huge advantage we have is we are one of the most traded, the jargon is liquid. So one of the most liquid currencies in the world, after things like the dollar and the euro, etc. One of the emerging market currencies that's most easy for global investors to buy and sell is the rand. And the reason for that is we've got a very deep capital market. So we've got very strong banks, we've got a very good exchange, and very well managed, well regulated financial system. And so foreigners will buy and sell our rands with ease, and that makes us very susceptible to global tides, let's say. And so there is almost nothing that the government can do to pick up the rand or to make it fall if they really wanted to do that as well. We find ourselves at the mercy of a lot of global sentiment. So, for example, if the world is reasonably positive mood, which it seems to be in the last sort of almost want to say 24 hours, we watch the rand go from 18 to the dollar to 17.70, and we have nothing to do with that. It's not like we suddenly became a slightly better country or our economy grew a little bit faster or something like that. That's entirely global factors. It's geopolitics at play, and our rand moves. And the only impact that a South African institution can have on the rand would be the Reserve Bank. And what they can do is they can keep interest rates high, which is currently what they're doing. And the reason they're doing that is because they're trying to make the rand an attractive place for foreign investors to store money. Because if they can store money here and earn 8 or 9% a year, it's much better than what they can do if they can store money in let's say the US at 3% a year. So we don't want to be in a position where suddenly, you can get 3% on rands or 3% on dollars, because guess what? People are going to move their money out of rands and into dollars. So that the Reserve Bank's the only institution that can influence the rand, and I would say it's a small impact. Global dynamics move the rand a lot more than anything else. The only time we unfortunately can really affect the rand would be by dragging it down. And you'll remember the weekend special, and I'm not talking about Apalele Fassi, the famous South African fullback. I'm talking about the other one, the Minister of Finance, who was there for a few days. His appointment, and I think I was almost live on the show when that happened, had a catastrophic effect on markets and most especially the rand. And equally, when he was then booted out of the job, so the rand recovered. So a major political misstep can cause the rand to lose a lot of value. But unfortunately, the other way around won't see the rand, for example, going from 18 to 14 to the dollar if we do something amazing in politics. I think it's kind of a one-way street. We might creep up over time, and the rand might get stronger gradually if our economy grows and our politicians manage to behave and play nicely in the government of national unity. But go the other way, and we can collapse the rand very quickly.
Is there any benefit to having the rand traded in this way? I mean, it goes up and down all the time. It can be incredibly frustrating. But I suppose the benefit would be that because we're an open economy, goods flow in and out of it very easily, and that's generally a good thing. It might help to, it means that food prices might be a bit lower, for example.
I think it creates the opportunity for good news to happen. And so just to understand where we are right now, we're in an environment where interest rates are high. And we certainly looking at an inflation rate that's declining. And so if interest rates start to come down, that means that things like our mortgages will get cheaper, and it means that companies have a little bit more cash flow to invest in growing themselves, and buying more stock. The government has a little bit more breathing room because interest rates are lower. They have a little bit more cash to pay down some more debt or do some more infrastructure spending, and so when you've got a very liquid, very open market, if you actually do things well and you take the right steps and the right actions, then this liquid market becomes an incredible strength. And investors feel great comfort in allocating money here because they can see things are going well, and they also have the comfort that they can pull their money out if things aren't going well. So I think that it's an enormous strength, Stephen. I think it's just, unfortunately, because it's liquid, it's also a very, very quick and almost immediate price on what the market thinks of what's going on in the country at a moment in time. So when we're behaving badly or not doing the right thing or not getting the reforms, then we see a weak currency, and when our economy is not growing, we see it there as well. So I think, unfortunately, we've just seen what the world thinks of our policies and maybe our lack of execution of those policies, and that's why we're in the situation we are in now. But it's not a one-way bet. It takes good action. And we could see the exact opposite, and then we would all be thrilled with what's going on, I guess, except for the mining houses who sell their commodities in dollars, and they would love the rand to be weak for a long period of time.
I mean, the other examples, of course, Liz Truss as the British Prime Minister, the reaction to the British pound on Brexit, all sorts of other examples. Okay, how does the rand then influence our money? We're dealing in rands. The rand goes up and down. Obviously, it affects what we can buy and how much things cost.
So let's start with the one that I think is almost core to the whole country, and that will be the fuel price. A country like ours, and I mean we don't have a lot of fuel in the ground, that we can pull out and convert, let's say, gas to fuel. So it means we basically buy every single barrel of oil that we convert to fuel and consume in our country, and because that's dollar denominated. If the rand is sitting at 19 to the dollar, it means that our fuel is more expensive, and that's inflationary. Equally, when the rand starts to go through a period of strength, and potentially now, for example, where we see the dollar price coming down again, then you might get a time where you've got a strong rand and a low dollar price of oil, which means that we're in a deflationary environment, which would be a huge relief to us. That means our fuel prices get cheaper. If that happens, it means inflation goes down. And if that's falling inflation means food's getting cheaper. The goods we buy are getting cheaper. And that means the Reserve Bank looks at this whole situation and goes, well, hang on, we don't need this massive sledgehammer of interest rates to deal with inflation right now. We can kind of lighten the load on the whole economy because inflation's under control, and that might just be the spark that causes a further economic growth and some sort of acceleration from 0.5 or 1% a year, whatever it is at the moment, to 2 or 3 or 4%. So the rand and most especially the oil price are big factors in the way that our money will move. And just to understand that, once we get that sort of kick on of positive sentiment, we look at things like, the bond market. And if the bond market, the prices of bonds are move in the opposite direction to interest rates. So if interest rates are falling, it means the price of bonds is rising. That's very good for most of the big retirement funds, pension funds, etc., lots of retirees. And so if interest rates are going down, it also means that stock markets might do well because high interest rates are a drag on share prices. It means that companies don't have capital to reinvest, etc. So it's an enormous impact almost in every part of our lives, the rand and how it affects our investments.
We're going to talk about investment strategy in a moment. First, we have a question from Mary. She says, hi, my investments are really unpredictable. Their value changes all the time. How can I invest in more stable assets that are less volatile? We'll have an answer for you, Mary, with Warren in just a moment.
The Money Show.
Personal Finance with Warren Ingram.
Good to hear from you this evening on 011 883 0702 and 0214460567. Your questions for Warren. Mary's question, Warren, was my investments are unpredictable. Their values change all the time. How can I invest in more stable assets that are less volatile? There was a time when I would have said gold, but I wouldn't say that anymore, Warren.
Gold is a really funny beast because it can do nothing, and then all of a sudden it wakes up and doubles or halves in a very short space of time, and then you'll hear a bunch of people saying, "I told you so," or "Oh no, I can't believe it." And I think Mary's question gets to the heart of that trade-off between the need for certainty, which is a really human thing. We would all much prefer to live in a predictable, stable environment, and that would be wonderful. The problem is that the assets that give us growth on our money, especially growth that goes faster than our cost of living is rising, those assets are highly unpredictable and highly volatile. And so, I just want to say to Mary, I think I would be really cautious of giving preference to an investment that is predictable and stable. If you look at, for example, take a fixed deposit. It's as predictable as you can get. You get a guarantee from a bank or from the government through those RSA retail bonds, and you know exactly what you're getting. You're getting, let's say, it's 7% a year, and whenever you get that, you can look at your statement. It's only going up, and you feel great because there's no volatility, there's no instability. The problem is when your cost of living is rising at roughly the same rate as your interest rates, and then you have to pay tax on those interest rates. All you've done is traded stability and certainty, which is what you would like, for actually a worsening life, because the buying power of your money is going down every single day. So the fact that you don't ever see a loss on your investments is great. It's very comforting. But in 3 or 4 or 5 years' time, you're going to realize that money that you've got, which has never gone down, cannot buy what it used to buy 5 years ago. And so I think, understanding that the real risk to your money is a rising cost of living. And if you're not tracking that, then unfortunately you're focusing on the noise and the volatility and thinking that that's really the harm to your money. And it's not. If you buy a world stock market index or a global equity unit trust, and it's noisy, but it generally is noisy in an upward direction, especially over 5 and a 10-year period, it's giving you massive inflation protection, and that's really what you need. So I would say, go for some stability with your money, and by all means, have some money in fixed deposits, but make it a small portion, and make sure that a large portion of your investments are in those volatile, noisy assets. And just make sure they're well spread. I can't say the D word anymore because Stephen will tease me about that. But I think spreading your assets around local and global markets, buying a little bit of stability, a little bit of predictability, is the best thing you can do. Because 5 and 10 years from now, you'll be able to live the life you're currently living and maintain that lifestyle. You just need to cut out some of the noise from time to time.
Okay, let's just sort of look at your investment strategy when you've got a rand that's a bit volatile. How do you sort of manage that? And I presume part of it is about where you put your money.
Absolutely. Knowing that you can't control the rand at all, no one can. The moment you make that realization, it actually is a kind of a superpower, because then you start to say, well, if I know that the rand's going to be crazy, it's going to be a bit up and down and all of. Then what I need to do is make sure that I have some assets that are in rands, that I am earning interest on government bonds, for example, because our bond market is one of the most attractive in the world, and have some exposure to the JSE. It's one of the best performing stock markets over very long periods of time, despite all the bad news. But equally, I need to have some money exposed to dollars and pounds and euros, so that I get interest on those currencies and exposure to those stock markets as well. And I feel if you plan to spend your life in South Africa and therefore your money in rands, then you could aim to have somewhere around 25 to 50% of your investments in international markets. If you plan to spend a lot of your time overseas, you're one of those travelers and you're going to spend a lot of money overseas as well, then you probably want to increase that allocation to somewhere around 50 to 75% of your investments in global markets. So it's about matching where you spend and then making sure that wherever you spend the most money, that you should have a dominant amount in that currency. And so if it's rands, then by all means, have a chunk of your money in rands, but make sure you've got some global assets as well to give you that protection against the volatile rand. But the other way around, if you're spending in dollars, then make sure you've got a large proportion of your assets in dollars to limit the impact of the rand on you when you're spending dollars.
And investing in shares that are on the JSE but are really about the dollar. So things that are very international, and Naspers obviously, and Anheuser-Busch, shares like that. Is that worth doing as well?
I think so. I mean, it's sort of an anomaly situation now that if you look, let's say 60 or 100 shares on the JSE, the vast majority of them earn most of their money in currencies outside of the rand. So they'll earn a lot of their money. If you use the Naspers example, they earn a lot of money in China and a lot of money in India and countries like that. And if you look at a company like Richemont, it sells all the fancy handbags and jewelry, etc. They're earning everything from US dollar to Hong Kong dollar. And so when you're invested in the JSE, it's only really the insurance companies and some retailers and banks that earn most of their money in rands. And so the JSE is a great source of global diversification, but it doesn't give you enough because it doesn't give you exposure to the big tech companies, the big pharmaceuticals. But certainly it's not a measure of the South African economy anymore. It's a very much a global emerging market, stock market now.
Warren Ingram, thank you so much. Personal Finance with Warren Ingram, a certified financial planner at Galileo Capital. If you missed some of this, of course, it will be podcast.